Okay, we're we're going live on Facebook and YouTube. The meeting is started. Let me get everybody in. Welcome to Personal Finance. Today is, what is today? The 22nd of March. And we're going live in the Zoom meeting here in just a minute. Good morning, everybody. Hey, Aiden. Hey, Ashley. How's it going? I'm going to have to it seems like every week I have to remember how to do this Zoom thing. Meeting, personal finance. I'm going to let some people in. Hey, can you hear me on? Guess you can't hear me yet because you're not in the Zoom room. There we go. Okay. Welcome in the Zoom room. Welcome. If you can hear me, give me a sound check, please, and we'll get started. Testing, testing. Can you hear the audio on Zoom? Somebody. Awesome. Thank you. Okay. Looks like we still have some folks joining in the Zoom room. And this is a full classroom, full to capacity. There's no room for any other human beings. Well, except for maybe 54 chairs are empty out of 58. How's everybody doing? Anything fun happen on spring break? Nothing? Some what? Studying? Catching up? Yeah, good. Me too. I spent some time working on investment strategies, so that's what's coming. So before we get started, I'm going to tell you what we're going to talk about today. It's 10:02, so I shouldn't say too much too quick because you know how it works on Zoom. We will have a lot of folks coming in over the next few minutes. But for those of you who are here, welcome. I wanted to say this week's assignment was posted in Blackboard with a due date of today, but it was brought to my attention yesterday that the syllabus said it wasn't due until next week. So for future reference, I would always go by Blackboard to be safe. Occasionally things change as far as assignment due dates, but I went ahead and changed it. So this week's assignment is technically not due until next week. So we don't have an assignment this week, which means we're going to be playing fast and furious for the rest of the semester. But that's okay. We're not behind. It's just I usually like to stay ahead, and we've done that until this week. This week we will get to where we should be, I guess. So just FYI, for those of you who are paying attention, you might be able to help a student who's not paying attention by sharing that information. I appreciate you bringing it to my attention yesterday. So anyway, that was one piece of information I thought you might want. Today what we're going to do is we're going to talk about what's next. This is kind of the midpoint in the semester. So we're going to transition into investment management and things that, at least in my experience, have been the most popular topics in the course. Investment management, we're going to talk about investment strategies. I'm going to teach you how to set up the perfect investment. We're going to talk about that today as I transition into investment strategies, investment management. That's going to be the next few weeks. Investment strategies, investment management. But today we're going to transition. So that's one of the things we'll do at the end the last third of today's time together. Second, we're going to review a little bit of insurance. Since we have this extra time, I usually like to spend a couple of weeks on insurance and just make sure that I've answered your questions. So if you have questions about insurance, anything related to insurance, go ahead and post those in the chat. You can post them on Facebook or YouTube if you have questions, and I'll try to answer those throughout this week. So we'll do that. But first, I want to share something that I posted a couple weeks ago, an invitation to U of H students. I think it's down here. I'm at missionalmoney.com. So you can see this is a podcast as well as a website. But it really what it is, I set this up to transition for students who take Money Study Group. This is free for U of H students. It's free for faculty. It's always free for my clients at Bayrock and their families. So what I've done is I wanted to set up an easy-to-use training portal, if you will. It's an online training course, really, but it includes a podcast. And so it's just getting started. But I wanted you to know about it before we transition into investment management, because for the next several weeks on the podcast and in the course that's at Missional Money, I'm going to be focusing on investment strategies. In addition to the podcast, the online course, I want you to see, this is, again, the page is missionalmoney.com, and you'll see that on that page there are three big buttons. The first button is subscribe. It means just click on that. It takes you to the podcast. So I'll click on that, and it'll take you to this page where you can subscribe to the podcast anywhere podcasts are played. You can also leave a review. It looks like it's loading very slowly, but at any rate, this is the page that you can click on. When you click on that button, subscribe, it takes you to that page, and that's the page that I've built for the podcast. So if you would consider leaving a review, and here's why I would like you to leave a review. This week you don't have a homework assignment. And so anytime, I learned this over the last few years, if you have a podcast, one of the things that's challenging is to get the podcast to even be visible in the podcast players. And the way you do that is you get reviews. So even if you leave a review and tell me what it is you would like to focus on after this semester, leave a question, a comment, leave anything you want in that review, but just leave a review. If you're thinking that you want to take your education in personal finance to the next level, this is for you. Now, if you're in this course, personal finance, just because you needed the credits and just because you're hoping to get an easy A, please don't bother going to Missional Money. It's really not for you if this course was just something you needed and you wanted to get an easy A. But if I've had so many students, I've had over thousands of students in this course, Money Study Group, over the years. And I keep talking to students who want to continue learning about personal finance. So it's for you, it's for my clients, the families of my clients, people that I meet every day who know that either they need some help, or in most cases, people my age, they want their kids to learn about personal finance. So this page, Missional Money, is for you. And so I wanted to just kind of, let me get this out of the way. So it's now 10:09, so we're done admitting folks into the course. So back to Missional Money, that's missionalmoney.com. By the way, the name Missional Money comes from that third law of personal finance, which is the law of purpose and commitment. And over the years, I've listened to Dave Ramsey and watched and learned from Dave Ramsey. And he did, if you remember the snowball effect, remember the debt snowball is what he calls it. And when he introduced that, he talks about gazelle intensity. Have you heard that term? And so that made a lot of sense to me. The people that Dave Ramsey has helped to get out of debt, they've all come to a place in their life where they realized that they had to change their behavior and they had to have a certain level of intensity to push forward and to achieve that goal of becoming debt free. I told you the story about visiting Dave's office. I've been there several times. But when you go to his compound, he's got several buildings, and every wall of every building pretty much has these little handwritten declarations or kind of affirmations from people, from families, from individuals who have made the decision to become debt free. And so one of the things Dave started doing was just letting them write it on his wall. He filled up one wall and then another wall and then another wall until he had so many walls. And it's a pretty cool thing to see. And that's where this name came from. Missional is that idea of putting your money on a mission. Okay, so missional money is about financial planning and investment management. Those are the two things I focus on in my business at Bayrock Financial. That's the reason that I became an investment advisor, because I believe that the best way to help people in terms of adding value as a financial advisor is to help people have a good, clear financial plan that functions, that works. And in addition to that, obviously, investment management is a key to building wealth. So those are the two basic topics that we will work on at Missional Money. But I just wanted you guys to know that the Missional Money website is kind of the next step for you. And it includes these three components. So the first one is the podcast. If you'll subscribe and leave a review, leave a question, tell me what you're looking for, hoping for. If you're interested in moving forward and engaging in this next step, I will do a little shout out on the podcast and I'll talk about whatever it is you post in your review. So it will just be a way for me to understand what you're looking for. Go to the podcast, leave a review. And I'm asking you to do me a favor, obviously, because without engagement, a podcast doesn't exist. And so I'm hoping we can get some engagement, not just for students, but also for U of H faculty. So if you're a student who's taken this course in the past and you're hearing this, just know that this is for you. If you're on faculty at U of H, this is for you. It's free. And here it includes not just the podcast, but the next thing is enroll. So when you click on enroll, it will take you to the actual course. This is the same platform we're using for Money Study Group. It's just a different course. It's called Make Your Money Count, and it's based on my book, Make Your Money Count, where I unpack what I call the blueprint for financial success, which helps you create a compelling financial plan in a pretty short amount of time. So this is the course that I'm building to help people create a financial plan based on everything I know as a certified financial planner. In the course, I will teach you about financial planning and the steps you need to take to save more money, pay lower taxes, and really build a better retirement. So it's called Make Your Money Count, and that is that's the course that's part of Missional Money. And then third is the Let's Make a Plan part. And for those of you who have taken this course, you're very familiar with this page. This is the page that you use to register or log into your account if you're already registered. So all that is at missionalmoney.com. And if you would just take a minute to think about whether or not you want to be part of the next steps. So that is that. Any questions, comments? Let me see the chat. I was confused with the insurance assignment. Are we supposed to choose an insurance from the list you posted within the assignment? If so, how do we input the insurance we want into Bayrock? So let me try and answer that question. That's a great question. It's a good question related to insurance. So I'm going to just see if I can log into Right Capital. I'm going to log into my account, and I think I'll go to Billy and show you how Billy would do this. If I can log in, hopefully I can. See if the iPad works today. Billy, let's go to Billy. So I'm in Billy's plan, just like you would log into your plan. Man, this running slow today. So the question was, let me get this out of the way. The question is, so the insurance that I would think you want to add to your plan is home insurance and car insurance. So that's what I'm going to be looking for when I grade the assignments. Isn't that in the assignment instructions to add home and auto insurance to your portal, to your plan? We can take a look at that in a minute. But so when I go to profile, yes, question, Tian, hello? Okay, sorry. So here's where this, again, I'm at profile. So I'm in Billy's plan, Billy and Sally's plan. I clicked on the upper tab called profile. And in that's where I can add all of these different, what we call data cards. So we're going to look at insurance here in a second. This is also where you can link your account. So for those of you who are considering taking the next step, if you want to use this portal to the, to the full advantage, you would want to click on this aggregation, and this is where you would get to choose your financial institution. So this is bank level encryption. If you haven't done that, you're welcome to do that. It's a tool. It's a premium tool. It's a really helpful tool if you're working with a financial, if you're building a financial plan. So you can use this portal to build a financial plan. So linking your account is just one of the things you can do, and you do it in the same place you add insurance. So here we go to add insurance. We could click on insurance, and you see these are the list. You don't need to add all of these, but you would want to add homeowners insurance. So you notice this home. Well, I'm adding one, so I think we already have insurance here. Let me see. Yeah, we already have it, so I'm going to not add this one. What I just did was I clicked on Add Account, I clicked on Insurance, I clicked on Homeowners Insurance, and now it's adding another data card. So I don't want to do that. So I want to go to the one that says 1402 Sunset because I've already done that. And I see the coverage amount. That's what you want to add when you buy a homeowner's insurance policy. You get a quote. Your insurance agent tells you, they help you figure out how much coverage you need on your homeowner's insurance. So that's one of the insurances that you need to add. And that's how you do it. Now, some of you, I'm going to click on primary home and I'm going to hit save. And there's annual premium there. I've already added this. That's why it's there. You will have to add that yourself. But when you go to property, this is where you have to do this step first before you add insurance. So if you haven't done this, this is part of this week's assignment. This should be very helpful. You have to add the property first. So we added the property. This is the property for Billy. Now, I'm about to tell you a secret, and this is a very common question. So before you add the insurance data card, you have to do a couple things. A, you have to put the property into your plan. So in this case, Billy's home, 1402 Sunset, has been added to the plan as an asset. And in this data card, there's all these pieces of information that go into the financial plan, including how much is the premium, how much is the coverage, how much do we owe, what's the current value, what did we pay for the house, what's the annual rate of appreciation, annual appreciation, what's the annual tax increase. So that's 3%. That's a lot. It probably should be more like 2%. But at my house, I'm going to change that to 2%. At my house, the taxes have gone up a lot in the last couple of years. So it may be more than that. I'm going to hit save. So you're going to want to do the same thing. Now, here's a key. This is the question that I get a lot. Like, why can I not, I'm going to close this if I can, get it out of the way. So the question is, why can I not add homeowners insurance to my plan? Does anybody see what the answer is? If you have a house that you rent, you won't be able to add homeowners insurance to it because you're a renter. You can buy renter's insurance, but you can't buy homeowners insurance if you're a renter. So this software is smart enough to know that if you tell it you're a renter instead of you own, then you don't get the data fields to add the homeowner's insurance. Okay, it's pretty simple, but that's an important piece of the puzzle. So I hope I answered that question, and then we'll look at auto insurance too. Angie, can you leave a chat and tell me that you got a good answer there, or if you have another question, just throw it down in the chat. Good question. I see a hand raised. Does that mean you're good? Uh, yeah, that's for coverage. Let me look at see if I can log in. I won't be able to log into Blackboard because I need my phone to do that. Does anybody have the assignment pulled up? Do what?
Which one?
The insurance assignment.
Yeah, what are you looking for?
So just talk me through what's in it. It says you're supposed to add insurance.
So on Money Study Group, it says Insurance 101, and then there's a tab for the Insurance Assignment Review. And I think you're just supposed to go to your insurance company and like add a plan that works for you, which is what I started doing. I just went to the one that I have currently and then looked for one.
So you got a quote.
Yeah.
Yeah. So that's the big part of this week's assignment is to get a quote for auto insurance. Yeah. Yeah. Because I didn't expect most of you owned a home, but I do kind of assume that most of you drive a car. So the coverages that I outlined there are just the coverages that are involved in the policies. So you don't add each and every one of those to your portal and your financial plan, but part of your learning, part of your assignment was to understand the coverages that are involved in your policies. So I know it was 2 weeks ago, wasn't it? We did that assignment. And we didn't get deep into the coverages, so part of your job was as you get a quote for your insurance, for your auto insurance, you were going to have to do a little research to find out what coverages. Look at that. Maybe it won't let me in because I'm going to need my Duo thingy. Sorry about that. That was weird. I didn't even do that on purpose. Oh, right capital. Yeah, you. And the way, yes, the question was, we're supposed to research the homeowner's insurance, and then put it into Bayrock, and that is correct. So let me just talk about that for a minute, because in the homeowner's insurance, there's not a great deal of research you need to do. It would be helpful if you knew what coverages were involved in the homeowner's insurance, but that's not necessary for this assignment. But what is important that you do for your home is you've already done a little kind of research about how much money you're going to make, which is how you decided what home you could afford to buy, right? Hopefully you've done that. So you purchased a home, an imaginary home, based on what you believe you're going to be earning when you get your dream job. And so that home now needs insurance. So you do have to do a little research to figure out how much insurance will you need to protect that home that you now pretend to own? Okay. And not only do you need to know how much insurance you need to purchase, but that's where you're going to need to know how much is it going to cost. And so you can do a Google search. You don't have to actually get a quote, but you're going to want to figure out within reason what is it going to cost for insurance if you purchased a $200,000 home in Friendswood. You didn't, because there aren't any that I can find. But if you say you bought a $300,000 home in Friendswood, Texas, you're going to pay a different premium than somebody who bought a $500,000 home in Bel Air. Okay, so that's what your research is. I want to know that you've paid a little attention to what does it cost for insurance for that home. So that's all you're really doing in terms of the research for your homeowner's insurance. Hopefully that helps. So let's see. I wanted to take a look at any other questions there. I see. Okay. Let me see. Do you guys have any questions about insurance? Now's a great time to ask. We covered briefly home, auto. We didn't really talk about life or health or disability or long-term care insurance. So if you have any questions about any of those, either policies or coverages, now's a good time to ask before we transition into the next topic. I'm going to open insurance here and take a look at Billy's super cool car. And so we've got Billy paying for insurance. This is a data card for insurance. We gave it a name. Billy has a super cool car, so this is his super cool car insurance. He's the owner. The annual premium is $200 a month, so that's $2,400 a year. And we have bodily injury. Let's see what happens when we push on that. Oh, it just says the name, bodily injury. So let's talk about those for just a minute, because we talked about these last week, and I want to make sure you know what that means. This is a good data card to get a kind of good overview about what's involved in insurance. So part of your homework assignment was to tell me what these coverages are. So do you remember we talked about bodily injury? We talked about when you buy liability insurance in an auto, there are three numbers. Remember, three numbers. Remember what those numbers were? So in this case, the numbers for Billy would be 100, 350. And usually most insurance companies, when you look at your coverage, you're going to see the 100 and 300 on one line, and then the 50,000 on another line. When you do your quote, and that was part of your homework assignment for next week, is you're going to see those coverages on your quote. And you're going to see how much those coverages cost. So if you decide maybe you want more coverage, hopefully, my hope for you was that you would do a little playing around with your quote. Like if you're insured with State Farm, you could tell your State Farm agent or the support person who's helping you, do that quote. You could say, hey, how much would it cost if I increased this coverage to the next level? That's a good idea for you to do. That's what some people do every year when they shop their insurance. So it's a good idea for you to do that so that you can understand how much it costs to increase or decrease certain coverages. So we're starting with the liability coverage, the 100, 300. Does that seem like a lot of money to you for liability protection on a car insurance policy? Yeah, it's not a bad coverage. Probably most of you, when you look at your auto insurance, what you currently have or what your parents currently have, in my experience, I would say most of you have less than that. A lot less, like 25, 50. But remember what those numbers are. The first line of that bodily injury, the first number is how much your insurance company will pay for one person. They could be injured and go to the hospital and have hospital bills, medical bills, or they could die. And that's how much one person can receive because of your liability. The second number, the bigger number, is the aggregate for the claim, not for the year, but for the claim. So if you have 5 claims in a year, this number applies to each separate claim. So in Billy's case, the 100, 300, if he gets in an accident that's his fault and somebody goes to the hospital, any one person can get up to $100,000. If it's a school bus and there are 20 people on the bus and they all go to the hospital and half of them die, the most any one person can get is $100,000. The most the entire school bus can get would be $300,000. Does that make sense? So if that scenario happened, if Billy was driving really fast and he created an accident with a school bus and there were 20 kids plus the driver, and the driver escaped with no injuries, but the kids got thrown all around the bus and half of them went to the hospital and had $50,000 each in medical bills and the other 10 actually died, how much would the insurance company pay for Billy's claim to the other people who were injured as a result of his negligence and his liability? $50,000. Why do you say $50,000 each? So if that's true, if it's $50,000 each, how many people were in there? 20. So if we did 50,000 times 20, that's $1 million, right? So why would that coverage be applicable? Think about it. The insurance company isn't going to pay more than $300,000. So if you're going to divide it by 20 people, you divide 300 by 20 people. The 50,000 has no relevance. But if half of them died, probably they may get, who knows what the insurance company and how the adjuster dices that up. But the point is, the maximum that this claim will pay is $300,000 in that goofy scenario. Hopefully that never happens to anybody ever, but just to give you an example of how these numbers work, that's how that works. No one person can receive more than $100,000, and no claim in aggregate is going to receive more than $300,000. Okay? What about that property damage number? How does that work? So same scenario. Let's say that Billy's at fault and he causes the accident. And let's say that same example, it's a school bus. Billy causes the accident, the school bus rolls. It's a brand new school bus, and Kamala Harris loves it because it's electric, which means it's like 10 times more expensive than any other school bus on the road. So instead of a $100,000 school bus, it's $1 million school bus. How much will Billy's policy pay for the school bus? 50 grand. That's it. So that's how you kind of have to think about your coverage and what it means to you when you look at these coverages, whether it's liability or property damage. That's an auto insurance policy. That's how they all work in the state of Texas. So when you do your quote, you're going to see similar numbers. My hope is that you'll look at those numbers and you'll see how much it costs for each of those coverages, and then tell me what you learned, because that's the whole point of this assignment, getting a quote for your car insurance. It's just my way of helping you kind of practice learning the coverages. And there are other coverages besides liability. You notice these 2 check marks, comprehensive and collision. Let's talk about those for a minute. Comprehensive and collision. So if you have a loan on your vehicle, you have to have these coverages. Did you know that? Yeah. No bank is going to let you borrow money and co-own the vehicle with you, because that's what happens when you have a loan, right? You have a lien. The bank and you own the car. And so what is the bank going to want you to do to make sure that their investment, their asset is protected? They're going to make you have insurance. And if you let your insurance lapse, they're going to buy insurance for you, and then they're going to charge you for it. And chances are they're not going to look for the best rate. They're going to look for the person who sits right next to them that sends them a kickback every time they do a policy with them. So you have to have insurance on your home and on your car if you have a loan. Okay? That's just how it works. But in this case, we got two coverages. Let's talk about comp. That's what we call it in the business, comp, and collision. What does the word comprehensive mean? In total? Anyone else? All encompassing. I like that. It's everything. Comprehensive is very broad. So that's what comprehensive means. That's what the coverage provides, is comprehensive. But what's not covered in comprehensive? Or any insurance coverage, any policy with any coverage always has certain things that are not covered. What do you call those things that are not covered? It's on the quiz. No one? No, uninsured is something else. That's a coverage. That's actually a coverage. Uninsured is something that pays for your damages if you get hit by a driver who doesn't have insurance. That's uninsured and underinsured coverage. But if we're talking about any property coverage, there's always a list of exclusions, things that are not covered. Okay, so when we talk about comprehensive, even though that word means everything, just know that the policy has a list of things that are excluded, because obviously they're not going to pay for everything. There are going to be some things that are excluded. Things like, for example, rust. That's not sudden and accidental, right? Inherent vice is another one. It just means it was designed in a way that eventually it's going to break down. That's not covered. Mechanical maintenance is not covered. It's not sudden and accidental. Even though you may throw a connecting rod in your engine and it's sudden and accidental, it's because you didn't change your oil and you were racing your car. And even though that happened in a sudden way and it was accidental to you, the insurance company excludes that. And plus, anything that's covered by insurance and property insurance has to be sudden and accidental. It's not something that happens over a period of time, okay? But there's another big exclusion in comprehensive that I really want to make sure you know about, which is, it's even listed right here on the page. Comprehensive coverage, which you have to have if you have a loan, which is very broad, that covers everything unless it's excluded. It has one major exclusion you should really understand. And that exclusion is collision. It's confusing, isn't it? So you have to buy collision insurance, because if you run into something, that's a collision. And so that's coverage that's separate and specific that covers you in case you collide with something. And comprehensive, which covers everything basically, unless it's excluded, one of the exclusions is, yeah, we're not going to cover collision. That's a separate coverage.
And that's for like, if you don't hit anybody else, it's like a single person accident.
Doesn't matter how many people are in the accident. If you have collision coverage, your car is covered under your policy, whether it's your fault or not. Now, if you get in an accident with Billy and it's his fault, you should let his policy pay under his property damage, because then you would not have a deductible, which is another important piece of this puzzle, is your deductible. So you've got, in this case, this is Billy, but pretend it's you, and you've got $1,000 deductible. In that scenario, if you get in an accident that's your fault, or even if it's not your fault, if you file a claim for collision, you're going to pay out of your policy deductible $1,000. So for example, let's say you're driving a 2018 Lexus ES350. I would like to have a 2018 Lexus ES350 because that would be a 3-year upgrade from my 2015 Lexus ES350. How much do you think a 2018 Lexus ES350 would cost to replace if Billy totaled it with his really cool pickup truck? 32 grand? Probably pretty close to that. Pretty close. Maybe a little less. I really don't know, but let's say 32 grand. So let's say you do get in an accident with Billy and this is your car and you got $1,000 deductible and you're driving a 2018 Lexus ES350. In that scenario, you said 32 grand it costs to replace that vehicle. How much will you have to pay out of your pocket? 1,000. So how much are you going to get from the claim? If you have a $1,000 deductible, the car is totaled and it's going to cost 32 grand to replace, you deduct 1,000 and then you get 31,000. Does that $1,000 deductible make your premium, the amount you pay for your insurance, does that $1,000 deductible make your premium go up or down compared to a $500 deductible? Does a $1,000 deductible make your insurance cheaper or more expensive than if you have a $500 deductible instead of a $1,000 deductible? Yeah, it's cheaper. So again, this week's assignment is designed to help you look at the coverages you currently have and ask some questions about what would it look like if I changed a few things. If you have a $250 deductible on a 2018 Lexus ES350, do you think your insurance is costing more or less than if you have a $1,000 deductible? Less? More? More. How much more? I'm not really sure, but it's more. And so then you have to do a little mental calculus. And the best way to do that is with your insurance agent helping you get a quote so you can see the difference between the $250 deductible and the $1,000 deductible, because maybe you save $750 a year. If you saved $750 a year going from a $250 deductible to a $1,000 deductible, how long would it take for you to save enough money in your bank account to cover the difference if your car got totaled or if you had a claim? If you were saving $750 a year because you raised your deductible, how long would it take for you to save enough money in your emergency fund so that you had the cash in the event that you got in an accident and totaled your car? If you're paying an annual premium, and if you saved $750 by raising your deductible, it would take, what, a year and a quarter to actually save enough to cover the difference. And so then if you don't have an accident for 2 years or 3 years or 4 years, if you're a really careful, good driver, which deductible would you want? I mean, that's how you do this business. This is how you become a more informed consumer about insurance. Okay? That's all this is. I'm trying to help you understand how do you make good, wise decisions with your money in the context of insurance. You do the same thing with your home insurance. You do the quote, you figure out what's the deductible, what are the coverages, what's your exposure. I mean, like in this case, if this is how I would advise clients when I was a State Farm agent. If you're driving a nice new car, if you're living in that nice house and you're making really good money and you have a lot of assets and you have this low deductible, I would probably say let's trade that low deductible, lower your premium, but let's look at these liability coverages that you have, and if they only had the 25-50-50 or 25-50-25, the state minimums are very low, And if they bought that from their old agent because that's how they saved money, and now I'm looking at them going, you live in this really nice house, you have all these assets, you drive this really nice car, and you've got this low deductible. That's what I call backwards, right? Because the big exposure would be if you get in an accident that's your fault and you don't have enough coverage. You saw that, right, in the example with the school bus. Doesn't mean you're going to get in that accident, but think about it. It's all about statistics. It's about the coverage, the protection. You're transferring risk to the insurance company. You want to be wise about these coverages because you could save some money on the deductible and you could increase your liability coverage a little bit so that you have much better protection. That's what Billy's doing here. He basically increased his liability and raised his deductible on his property coverages so that he could save some money, so that he could use some of that savings to give himself better protection to protect his assets. So in case he gets sued, he's got better liability protection. The same thing applies to a homeowner's insurance policy. If you look at your homeowner's insurance, when you get to that point, or your renter's insurance, it has Section 2, just like an automobile policy, which is liability. And you should consider how much coverage you have and how much coverage you need and what's the cost difference. And you might be surprised to find out that it's pretty inexpensive to increase your liability coverage.
So a higher deductible means that you're going to be paying less on your car insurance and you're also going to have more coverage in case of any.
Yes and no. So the question was, by raising your deductible, you're going to pay less on your insurance and you're going to have higher coverage. And the first part is correct. The second part is not. So I'm saying one of the strategies I would use if I was your agent, one of the strategies I would suggest you use is you do what you said the first part, raise the deductible, lower your premium, and use that savings then to go change the liability. It doesn't happen automatically. Each of these coverages are separate. You have to tell your agent, here's the coverage I want, or I want to see a quote with this different package. Because 99% of the time, when you get a quote for insurance, the agent or their staff is going to give you a template. Every insurance agency has a set of coverages that's automatically kind of defaulted. And they give you the same coverage they give the next person. They try to find the best bang for the buck for that area, but it's like a template. But you as a consumer get to choose between these coverages. So does that answer your question? If you raise your deductible, yes, it lowers your premium. But then I'm saying you might want to use that savings to look at your other coverages and find out where you might want to increase some of those coverages. Well, collision coverage doesn't have a range. It basically covers you for your car. So if you have the 2018 Lexus ES350, your collision coverage is going to cost X amount of dollars because your insurance company knows how much will it cost to replace your car. Your 2018 Lexus ES350 with all the options, leather seats, and it's color red. Red's going to cost more than color gray or white, which is why I always try to buy a white car. Because in Texas, it's less heat. A red car is more likely to get stolen. And for some reason, red cars cost more than white cars or gray, boring cars. So all the options in your car, based on that VIN number, your insurance company takes that and their actuarial department decides how much is it going to cost to replace that car. And that's your collision coverage. It's not like you can go buy more or less. It's one coverage. What you can decide, though, is what's your deductible. How much of that risk are you going to keep? Because the lower your deductible, the more risk you're transferring to the insurance company. Yes, sir.
So what would happen if you raised your deductible and then like a day later you get in an accident, you couldn't make the deductible?
If you raised your deductible today, and they made it effective today, which is how some agents would say we're going to make it effective at your renewal. So Aiden's question is a good one. He said, what if you raise your deductible? So you have a meeting with your insurance agent today and you look at all these options and you guys agree after several quotes, here's the package I want, and it includes a higher deductible. But the next day you get in an accident, it's your fault, your car's totaled, and now you got to use your insurance and your collision coverage. Are you stuck with the higher deductible? And the answer is yes, unless your insurance agent said, we'll make these changes at the renewal. And let's say your renewal is April 15th, it's right around the corner, that's my birthday. And most agents would say, we're not going to make changes midstream because we're close to the renewal. We'll wait until the renewal and then we'll make the changes. In that scenario, Aiden, you get in an accident tomorrow, you're still covered under the policy that you had because you haven't renewed yet and they haven't changed your coverages. So it depends. Some agents might go, hey, we're going to make the change right now, and then you're going to get a little $3 refund or whatever, to your policy, and all your coverages are going to change, and you're going to get a new declarations page and a whole bunch of paperwork instead of just waiting until renewal and everything just transitions. That's the best way to do it. If you happen to be taking notes and you're in the business, trust me, that's a better way to do it for most people. Okay, good questions. Any other questions? Well, let's see. Yes.
How do you calculate how much you really need, for coverage?
How do you calculate how much you really need for coverage? That's a good question. Which coverage?
Any of them.
Okay. How do you calculate how much you need for coverage? Let's start with a home. Or are you talking about just car?
Either.
So let's start with home. How do you calculate how much coverage you need for your home? How would you start? If you just said, I got to figure out how much insurance I need for my house, how would you start?
Maybe value the assets in your house.
Value the assets in your house? Okay, now you need to understand that your homeowner's policy has two different coverages for property. One is the house, it's called coverage A, and coverage B is for your contents. So Aiden's question is, how do you evaluate how much coverage you need for any coverage? So now you brought up two different coverages in the homeowner's policy. So your answer is correct if you're trying to figure out how much coverage you need for coverage B, which is personal property. You figure out how much those assets are worth. If you've got a whole bunch of stuff, including gun collections and, jewelry and fine furniture and the top of the line stereo equipment and computer equipment and all of that, then your coverage in coverage B needs to be more than the basic package might be. So that's how you would figure out how much coverage you need for coverage B, but that's only part of the policy. It's only one coverage on the policy. So now how would you figure out how much coverage you need for the main coverage, which is coverage A on a homeowner's policy? How would you figure that out? How would you, if I put a gun to your head, I don't have a gun with me. I'm not allowed to have a gun on campus. So I don't have a gun. But if I did and I put it to your head and I said, tell me how much coverage you need on your house, what would your thought process be? How would you figure out right now how much coverage you needed on your homeowner's policy for your home that you just bought that was a pretend mortgage? There's a hint there. The listing price of your house, that's one answer.
The actual market price currently, I know housing depreciates or
Yeah.
time, so
So we got two answers. One is the listing price, one is the market price. And that's really the same price, right? I mean, it's pretty much the same price. Maybe not. You might list it for more because you're in a really red hot market. And the market price should be 300 grand, but you put it on sale for 300 grand and you get offers for 325. So that would be the market price, even though the listing price was different. So that's one way. The market, let the market decide how much insurance you need. What else? There are three I'm thinking of. One is use the market to insure your house. which means you could be paying a heck of a lot more than you really need to. That's another hint. Another way you could do it is the way you absolutely have to do it at minimum, which would be, if you have a mortgage, what do you think their bank's going to require? They're going to require that you have insurance for at least the amount of the loan, right? So if you bought your house for $300,000 and you put zero money down, and you were one of those people that got into a bidding war, and you were lucky enough to get a loan for the ridiculous price you paid for the house, which is $50,000 over what it sold for last week because of, thank you very much, somebody's inflation program from the federal government spending so much money so fast that inflation keeps going up and up and up. And you happen to think, I got to get into this FOMO now. I got to get in now. I got to buy this house now. And so you pay $350 for a house that sold for $250 last year, and you get a loan for $350. How much do you have to insure it for? $350. And now let's say, Aiden, that it burns down in a fire and the insurance company is going to replace the house. How much are they going to replace the house for? You think they'll pay $350? No. What they're going to do is they're going to go in and look at what you had, and that house was built with basic wood and basic ingredients, builder's grade carpet. It hadn't really been upgraded yet because you had big plans to spend another $100,000 and renovate it, but that hadn't been done yet. The insurance company owes you for what you actually had with like, kind, and quality materials. And the fact that it's got a loan on it for $500,000 makes no difference in terms of what they're going to pay to repair the house. They're going to pay the actual cost to repair the house. They're going to pay the replacement cost if you have replacement cost coverage, but that doesn't mean they're going to pay the market value. It doesn't mean they're going to pay the I wish my house was this expensive value or any of that. They're going to pay the actual cost to repair with like, kind, and quality. So now my question is,
So, assuming like they build with the same material, shouldn't like depreciate the value of the house because it's still the same property, still the same material.
So yeah, it's still the same property, still the same material, but what was your question?
I'm assuming it still won't depreciate the value of the house
It wouldn't depreciate the value of the house.
after the accident, after burns down.
I don't understand the question. Of course it's going to depreciate. It's the value of the house, according to the insurance company, is what they insure it for, and their insuring agreement is to repair it or replace it with like, kind, and quality. So the fact that you have a loss, I don't understand the question.
Well, I was just asking, like, assuming like they build the same material, it's still the same property.
Oh yeah.
Assuming like the value of the house won't depreciate.
Right, because you had a claim. So you have a fire, you make repairs, that is not going to essentially make the house go down in value. No, yeah, it'll make it go up in value because it's new. Usually, if you get a good contractor and you remodel it, even if you're remodeling it with the same basic materials, it's now new materials. And the insurance company, if you have replacement cost coverage, which you absolutely want to have, you should make sure you have replacement cost coverage, because then they're going to pay you the full cost to replace that with material of like, kind, and quality. But they're not going to pay you to go in and replace it with the best material you could like if you had countertops like this table Formica, that's what they're going to pay you to replace. And even though after the claim it's going to be new, which makes the house more valuable, it's essentially the same house as it was with replaced material. But what you can't do, even though you have a house that you bought for more than it was worth and more than it would cost to rebuild it, even though you bought it for more and you have it insured for more, they're still not going to pay you to build it back like a $350,000 house with all of the finest material. Does that make sense? So you need to understand how all that works. Replacement cost coverage is an important piece of that too. Does it say? Yeah, it doesn't really say in this this is a pretty limited data card for your homeowner's insurance. It doesn't say if you have replacement cost coverage. Let me get rid of these extra ones. So good question. Okay, we're at 11 o'clock. If you don't, any other questions about insurance, any questions at all, speak now or we're going to move on. All right, I'm going to jump into, I'm going to talk just for a minute about your assignment. This is the assignment that's coming up. Again, this week your assignment is the same assignment it was last week. No new assignment this week. It's insurance. But what you're going to do next week as we get into investments, and I'll talk about this again next week, you're gonna do a retirement analysis in your plan. So you're going to learn some things about investing this week, not this week, but next week. And so I want to introduce investing. When we think about, now I'm going to assume, let me ask one more time, any questions about insurance? I don't see, I'm going to look at the chat. Yes, Charles, you're also more likely to get pulled over by the cops if your car is red. It's true, especially if it's speeding and it has a big engine and makes loud noises and is driven by a guy. Guys are, well, I don't know if that's true. Probably ladies get pulled over as much as guys, but guys generally get more tickets because they're usually driving faster. Did you know that? Did you guys know that? Your car insurance, if you're a guy, is more expensive than if you're a girl. Yeah, if you're young. If you're young, your insurance is more expensive. As you get older, like when you turn 25, typically, your car insurance rates will go down. So I should talk a little bit about discounts for car insurance because most companies give you a discount, a pretty good discount, if you get good grades in school. Why do you think that is? Yeah, it's a responsibility discount. So insurance is all about, the insurance companies have a really good system for measuring and qualifying your character. There's a thing called moral risk, morale risk. Anyway, people that demonstrate high levels of responsibility are much more attractive in terms of being customers to insurance companies. And so one of the things they do to attract good quality clientele is they give discounts to folks who are good students. So it's a big discount. Typically, it's a big discount. It's important. But yeah, when you get older, when you turn 25, your rates come down significantly. But while you're younger, those discounts like good student discount, those all help. And because your premium is so high, because you're young, those discounts tend to seem a lot bigger, and they are. So they're important. And you should make sure you're getting those discounts when you do your quote. Okay. Where do we start? I want to talk about investing and investment management, investment strategies. But to do that, I've got to kind of set the table. And remember back when we were talking about missional money and the financial planning, and the whole idea of missional money is to focus on two big categories. One is investment management, and one is financial planning. And I don't know which one. I think financial planning moves the needle a lot more than investment management, but they're both obviously important. And clearly, a topic that's most popular in this course has been investment management, investment strategies. So investing is something that I want to make sure you understand. But I have to try to do my best to help you put it into context in your financial plan. And that's why your first assignment when we get into investing is going to be to calculate the cost of retirement. Because you're going to need to understand how much will it cost you to retire so that you can invest with a much greater level of understanding and discipline over time. And I promise you I'm going to teach you how to do that. But I also want to teach you the importance of having a plan and of making your investment strategies and your investment management and your investing in general fit into your plan. I have so many friends who are into investing, and they invest and they pick stocks and they trade, and that's great. I trade too. I trade more than I should trade. My wife asked me the other day if I was a day trader, and I said no. And then I got an email from Charles Schwab, and they said I am now designated as a pattern day trader. Are you, Aiden, a day trader?
I wouldn't be considered one.
So there's certain things that you do, like I don't know if you guys pay attention to the market, but it's been going up and down a lot lately, and it came down significantly a couple weeks ago, and I had bought something and got stopped out, and then I bought it again in the same account, and that triggered the day trader. So if you buy and sell something in the same day, the same holding, you'll be tagged as a day trader. So officially, I'm a day trader, but I'm not a day trader. It's a stupid way, I think, a stupid way to live your life. Now, if you're a day trader, I don't think you're stupid. You're probably smarter than me, but I want to do other things with my life. So trading is not exactly the same as investing, but it's part of it. And so in the course, I'm going to go over the differences between trading and investing and how they work together. But for you, I want you to know that I'm not here to teach you how to be a trader. That's not part of really this course in Money Study Group at all. You'll get some of that in Missional Money. I'll talk about strategies for trading and why they're important, but that's not our job here in Money Study Group. But to talk about investing at all, investment strategies, investment management, investment planning, we have to start in the context of a financial plan. So lucky for you, we're going to work in your financial plan to create your investment strategies, to put them into work. So you're going to get to see how they work inside your financial plan over the next few weeks. And as we get closer to your capstone assignment, you're going to get to see how all of these pieces come together in your capstone assignment. And I'm going to make it easy for you as we move forward. But this is one of the places you're going to want to pay attention. So does anybody know where we are right now in your financial plan? Did you see how I got here? We're in retirement, but how did I get there? Remember, we have the top tabs and then the lower tabs. So in the top tab, we went to retirement. And then we're at the lower tab is analysis. So just know that that's where that is. And if you scroll down the bottom of that page, you have these action items. And if there's one piece of your financial plan, the planning portal, whether you're at Money Study Group or in Missional Money, if there's one piece of your financial plan that is the workhorse of the entire plan, it's this screen right here. This is all these data cards in one place. And so if we want to see the needle move on your retirement plan, this is a great place to become familiar with your financial plan and what can move the dial or move the needle. And you're going to do that in your upcoming assignment. I just wanted to kind of highlight it. But one of the things I want to talk about today as we prepare to get into investing is I want to talk about the perfect investment. You guys, what do you think of when I say the perfect investment? A diversified portfolio? That's a good guess. It's not correct. It's not what I think of. When I say the perfect investment, I have one thing in mind that I want to teach you, and I want to make sure that when you graduate or when you finish this course, you understand this perfect investment and how to put it into place so that you benefit from this perfect investment. So many people I've worked with over the years had no clue how powerful the perfect investment was, and they missed out on it altogether. Aiden, what do you think? The perfect investment.
Highest ROI.
Highest ROI. Yeah, I'd say this perfect investment has the highest ROI. I have to say, full disclaimer, since I am a fiduciary, I am a professional investment advisor, I should say, for the record, there is no such thing as a perfect investment. There. Now let's talk about the real perfect investment, because there is something that I consider to be, above all investments, the perfect investment, if it's available to you. So still, anybody want to take a guess? Real estate? Not exactly the perfect investment. It's not a bad investment. I own a lot of real estate, and it's done very well. Aiden, you know, my favorite investment of all time is the SPY. It's an ETF, an exchange traded fund. If I could only invest in one security, in one ticker, it would be the SPY. And I would encourage you, if you're interested in investing, to get to know the SPY and what it's made of. In fact, that will be one of the featured tickers that we look at every week in Missional Money when we do our kind of our investing. I call it the Monday watch list, SPY. But that's a specific investment. It's my favorite security if I could only trade one security, Aiden, but that is not the perfect investment. Anyone else want to take a stab at it? I don't see any comments. Let's check Zoom. No one on Zoom is chiming in. Let me answer this question for Angie. Do we have to get a quote, or can we use our current car insurance? Angie, what I would say to answer your question is use your current car insurance, call your current car insurance agent and get a quote so that you can show me what you learned about the coverages, so that you can say, here's what I currently have, and here's the quote that I got to show the things that I changed, and then tell me what you changed and what you learned. That's the whole point of the assignment. So back to the perfect investment. We're running out of time. I want to make sure you understand the perfect investment. Nobody on Zoom is leaving a comment. If you're on Facebook or YouTube, go ahead and leave a comment now. What do you think the perfect investment is? Going once, going twice. An investment in yourself. That's the most common answer, and it's a great answer, to invest in yourself. But it's not what I'm considering the perfect investment. So let me tell you what it is. You guys, most of you who graduate from the Bauer College of Business at the University of Houston are going to get a job in a corporation. Most, because this is a business college, not everyone. And if you do get a job at a corporation, most of the places you will be looking for a job offers this very special benefit called a 401k. And within that benefit, they typically offer what's called a match. So I want to make sure you understand the perfect investment. It's really it's the match that comes with your 401k. And here's why it's the perfect investment. Because it's like leaving money on the table when you don't take advantage of the match in your 401k. But when you do take advantage of it, some things happen. So as we get into investing, as you do your first homework assignment related to investing, you're going to calculate the cost of retirement. And my hope is that as you start to see how much it costs for you to prepare for retirement, my hope is that you're going to feel the weight of how big that goal is. That's my hope. That you go, oh, there's no way I can do this. That's my hope. Isn't that terrible? I'm a sick person. I want you to know how much effort it takes, how much commitment it takes for you to plan to retire. Like, I planned to retire at age 50. I didn't really want to retire. I wanted to have the option to not work for a corporation. And I want you to have that same option in your life, but to do that, you have to make some serious commitment. And so when you do this assignment, you're going to basically be finding out how much money you have to save to prepare for retirement. The cost of retirement is big. Dave Ramsey says, how much should you put in those baby steps? Remember the baby steps? How much does Dave Ramsey say you should invest in retirement? Oh, spring break. We forgot everything. 15%. Okay? That's a lot. It's a good number. Saving 15% of your income. So let's start with this scenario. Let's say that we make $100,000 a year. Everybody makes $100,000 a year. How much do you need to save 15%? 15,000. So that's why I like 100,000. Simple math. I like simple math. So let's talk about the perfect investment. While 15%, saving 15 grand when you make 100,000 is not that easy for most people. But with the perfect investment, I should ask you how you feel about saving 50. Does that seem like a really high bar? I promise you, most people don't do it. But the people who do, and they do it smartly, the way I'm going to teach you to do it, it works out really, really well, especially if you understand the 4 investment strategies that I'm going to teach you that are designed to help you maximize returns and minimize risk. That's what I'm going to teach you next week. You don't want to miss it. But I want to make sure you understand the perfect investment, because as we look at the cost of retirement, one of the ways you can mitigate or reduce the weight of that huge challenge is to take advantage of the perfect investment. Here's how it works. You get a job, you make $100,000. Let's say the company you work for has, what's a good percentage for a match? Aiden, what would you say if you got the job you want and the 401k offered a match? What percentage of a match would you hope for? So let's talk about what it is. The match is like this. If you work for, I'm going to use Shell, and I think Shell has a 6% match. I'm not sure, but I'm going to pretend they have an 8% match. So if you make $100,000, and if you participate in the 401k, if you sign up on that first day, which I want you to do, and you say, yes, I want to participate in the 401k, the next question is, how much do you want to participate? And you have to know how much will they match. And because they're matching 8% in this scenario, how much do you want to contribute to your 401k when you sign up? 8,000, because that's 8%. So boom, you contribute. You say, yes, I want to participate in the 401k. How much? I want to put 8% because that's how much they match. And that is the perfect investment. Because what happens at the end of the year when you put in 8%? You make 100,000, so you put in 8%. And at the end of the year, how much do you have in your account? 16 grand. See why I use 100,000 and 8%? Because what does Dave Ramsey say? How much should you save for retirement? 15%. And how much did you just save for retirement? And not only that, the reason that I call this the perfect investment is because what happens to the $8,000 you put in terms of your April 15th duty to respond. My birthday is April 15th, in case you didn't know that, which means it's what day? Tax day. April 15th, you file your taxes. And what happens if you participated in your 401k and if you contributed that 8% so that you get the match? Now, how much does the IRS think you made in that year? You made 92. So how much do you pay tax on? No, the total. How much does the IRS say you need to pay taxes on? How much? 92, not 100, but 92. So you get a tax deduction. You get a match. You see why I call it the perfect investment? It's like if you don't know where to start, start there. I have met with so many people who come into my office wanting financial planning advice. It would be really foolish of me not to find out if they're doing that. You'd be surprised how many people don't do that. I hope you're not one of them. On day one, when you get that job, I want you to have absolute clarity about what you're going to do. Yes, you're going to sign up for the 401k. Yes, you're going to know how much the match is. And yes, you're going to contribute at least as much as the match. Everything after that, how you invest that money, which will be something you need to learn next week. You will be learning that in the next few weeks. So to start with, though, the perfect investment is really more about financial planning because a 401k is not an investment. It's a type of account. It's simply an account with certain tax advantages. So I'm going to teach you about tax advantaged investing, which is all about the types of accounts. But what you put in those accounts, what you invest in those accounts comes down to asset classes. And you're going to have to learn about asset classes and asset allocation. So the 4 investment strategies I'm going to teach you next week: diversification. I'll tell you the story about Enron. The next one is asset allocation, the most important element or determinant of your portfolio's returns is asset allocation. Dollar cost averaging, which is the most powerful strategy you can use at your age to grow wealth. And number 4 is portfolio rebalancing. Those are the 4 investment strategies designed to help you maximize returns and minimize risk. Come back next week, and that's what you're going to learn. And we'll start next week with those strategies. So have a great week. Any questions here before you hit the road? Yes?
You say that 8% is average, or
That's high. 8% is high. If you could get an 8% match, you're doing really well. I think probably 5 may be high average. It just depends on what industry you're in, really. If you're in the oil and gas industry, it's going to be a little higher typically. But it depends on the industry and the company and the benefit package in general. So it ranges. But just you need to know what that match is because that is the perfect investment. Okay, I'm going to take a look at the chat. See something that isn't hard to manage. Investment. Yeah, okay, great. You guys had some good answers, but they were all wrong. But that's okay. The perfect investment is that match you get in your 401k. All right, I'm going to close down the broadcast and I'm going to close down the Zoom meeting.